And on today's show, how indices work in an index universal life policy. Part 3 of this week's series on premium financing using index universal life with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Insmark, Life Specs, and Backroom Technician. Let's get down to business. Welcome to the show, Robert.
Thank you, Steve.
Day 3, I have to say, I'm pretty excited about this. You've really kind of lit our minds up, I have to say. Some of this is revelatory, and I want to walk back through kind of a redux of yesterday's show, using this, what I call, very intense bar graph here. Walk me through what's going on here, because and by the way, you need to watch yesterday's show, especially the second segment, to figure out where we're at on this. This is going to be a great explanation for you to understand why a standalone indice sometimes will not have the potential probability of a blended indexed.
Absolutely. So here I'm showing the effect of arbitrage and how arbitrage actually is captured. And again, when you actually illustrate arbitrage, you are assuming a given crediting rate. So for example, if we want to illustrate at 6.9% and you plug 6.9% into the illustration software is going to assume that you're getting 6.9% every single year. But in reality, you're going to be credited whatever the equity markets do, subject to your floor and your cap. Now this particular strategy has a floor of 0 and it's uncapped. So if we went back 25 years and we looked at the historical crediting rates that your policy would have received, here you can see what you actually would have earned. 16%, 5, 24, 6, 11, 0, 39, and so forth. So these are the actual crediting rates that would have been credited to your policy.
Now this is based on that blended
particular. No, this is that Barclays dynamic bond index strategy that is uncapped. And that I showed yesterday. So if they want to go back and review that.
But I just want to make sure I understand it. Am I reading to you this? You're looking at 25 years, which includes the lost decade, I'm assuming.
Includes the lost decade.
I only have, what, 3 years when it went 0.
And that's what's so fascinating about this, is that because there is this dynamic daily hedging where anytime the S&P is volatile, there's this reallocation away from stocks toward bonds on a daily basis. There are very few times where this particular index would have actually hit the floor, just 3 times in 25 years, which makes it a really good index for this particular type of strategy to capture arbitrage. Now, the orange line represents the guaranteed fixed rate 5% policy loan. So anytime the crediting rate exceeds that orange line, you're getting that spread, that arbitrage.
So this matters to pick an index that has really good historicity to it, and the platform that we're using going forward, I'm sure the fund manager, whoever he is, this is really a huge issue. So indices aren't just indices. They're not the same. A rose is not a rose.
Exactly. Okay. Absolutely.
Well, let's look at this. This is a case study. We're using Dr. Fred Schomburg, age 45. I'm just assuming he's non-smoker preferred. He's earning $500,000, my kind of client, and a net worth of $5 million, maxed out his qualified plan. But by the way, we see this a lot. He's looking for tax-free income, and his budget is $50,000 per year for 10 years. I really love this client. Walk me through the mechanics of the ledger here and show me what's going on with using IUL and premium financing.
Okay, again, the goal here is to, we start off trying to create leverage, and so his budget is $50,000 a year. So you can see over here in column 13, that's what he's going to be spending, and that translates into a premium, as you can see in column 3, of $208,000 a year. That's the actual premium that we're going to be borrowing. In this case, we're going to borrow all those premiums up front year 1 and put all of those premiums into a premium deposit fund account, as you can see in column 4. The reason that we're borrowing them all up front in the first year is to actually save interest. The particular lender that we're using gives us a lower interest rate if we borrow a larger amount. So as you can see, the interest rate in column 5.
So there's break points to this issue.
There are break points.
Oh, okay, so we think, well, we'll only borrow as needed. Maybe not.
Correct. Now, sometimes we do borrow as needed if it's a large enough case, and we don't need to, to use premium deposit accounts. But in this case, we saved enough interest that it made sense. As you can see, LIBOR plus the spread started at 2.75%. I'm assuming that LIBOR is increasing. As you can see, I'm assuming 20 basis points of increase per year every single year from year 1 to year 10. Based on that assumption, my interest is going up. We always mix interest and principal together to levelize our loan payment. That's the reason that the out-of-pocket is levelized at $50,000.
And he was ready to contribute to that at 50 grand anyways.
Correct. Now that does two things. Number one, it makes it easier for him to budget. Rather than having a rising interest payment schedule every single year, he has a more levelized payment schedule, which is not guaranteed, by the way. If interest rates rise faster, he'll have to add to that. If interest rates don't increase as quickly, he may not have to pay as much.
Okay, Robert, before we go back, can you go back there?
Yep.
Okay, so if I understand what you just said, since he was ready to lay out 50 grand for 10 years, we reverse engineered to that number to come back to this. Because people are going to say, how did I get there?
Exactly.
Well, we already knew he was going to commit to 50,000. I love this idea because then I can keep within the confines of what he already scheduled in his mind, what he could afford, and then you worked backwards. And I also appreciated, Robert, that you actually gave me a 20 basis point increase. So it shows that a little good faith here. We think interest rates are going to rise, and that really makes us great.
And this has to be monitored. If we're not getting the crediting rate that we had hoped to get or that we had illustrated, then he might have to add to what he's putting into the policy and vice versa. So these transactions have to be monitored each and every year. There's, post-sale, there's a lot of work that has to be done in these transactions.
When we come back from the break, we're going to continue in this case study because I think it really does unpack and unbundle some of the thinking behind your patent pending methodology. I love all this stuff. This is great. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with funding strategist and attorney Robert Strauss. Robert, you're walking us through a case study of this physician that we talked about in the first, and we're still in that.
Yep.
I love the idea. We put his target was 50,000 for 10 years. We reverse engineered this.
Correct.
Now, walk me through the spreader because you are pointing to two arrows here. I love these two columns you're comparing to because this is what we're talking about, arbitrage on interest rates. We're trying to do something functional that the client wants. Walk me through the mechanics.
Okay, so again, we really want to do two things to make sure that we are able to pay off the loan on schedule at the end of the 10th year. So first, we require the client to pay all of the interest out of pocket. So there's no accrual of interest. The loan balance is not getting any bigger. Second of all, we're prepaying some principals. We're mixing some principal into the interest payments. And that does two things. One, it makes it easier for him to budget. So his payments are a level $50,000 a year instead of increasing. But the other thing that does is because we're mixing some principal in, he's actually prepaying the loan a little bit, and that reduces the collateral requirements in column 10. It actually cuts the external collateral in half without resorting to high cash value riders.
So how long did it take me to get to that 50%, that half?
Well, right away. In other words, right off the bat, it reduces your external collateral requirements in half. So that is the reason that we have this design. And then at the end of 10 years, we know exactly what our loan balance is going to be. It's going to be exactly what we borrowed initially. It's a mathematical certainty because he was paying all the interest out of pocket.
The banks love this.
Banks love it.
They love this.
Insurance companies love it because they know also that the client's got skin in the game, and they know exactly what the loan balance is going to be, and that there's an exit strategy, and it's an early exit strategy. So at the end of the 10th year, you can see that the loan is being paid off. From that point forward, it's self-financed, and the lender is now out of the equation. There's no assignment against the policy. Now the client can actually access his cash value. It's his policy again.
And is this the actual premium loans?
Yeah, let's go to the next slide.
Okay.
And you can see from less than a decade after paying off the lender at just a 6.9% assumed crediting rate, you've got here the income stream ranging from 174,000 to 261,000. Now, here I assumed I used an inflation rider here with an assumed inflation rate of 3%, which is the built-in inflation
that
rate.
You're using arbitrage for your patented patent pending methodology. They mostly give a COLA or some kind of
Most do not. This particular carrier does.
This just happens to do that.
This one happens to do that.
By the way, just a little side note, I love that.
I really like that, you know, because if interest rates happen to go up, which is one of the concerns the clients have, what happens if interest rates go up during the first 10 years? Well, yes, you'll be out of pocket a little bit more during the first 10 years if interest rates go up, but then inflation will increase and you'll end up recovering it later on.
I think that's outstanding. So I'm looking at this specific carrier, which there are not too many carriers that give the COLA rider, if I'm hearing you correctly.
That's true.
So this is a great way to talk about future increases.
Correct.
I love that.
What other retirement vehicles or how other retirement vehicles might perform in comparison to SFI. So if we put the same $50,000 a year for 10 years into, let's say, mutual funds or stocks, or if we grossed up those contributions and put $83,000 a year into qualified plans, knowing that we could deduct that $83,000 at the 40% tax bracket, and it would cost us the same $50,000. And then we took out the same amount after tax income. How long would that income last? And as you can see, with these other retirement type vehicles, we would run out of income pretty quickly when we try to match the income streams. Now, of course, I applied the tax effects of how these other retirement vehicles are taxed.
And this is actually your program, isn't that?
This is my program. We run this for everybody.
Okay. All right. Well, now I just want to make sure we're talking about the same things again. We're just as a redux.
Yes.
We wanted to target the client's desire. He already maxed out his ERISA product, his 401k, let's say it was, his qualified plan. 50,000 was our target. We we actually reverse engineered to get to how much loan we could do based on what he thought he was going to pay out. Now, what can I tell the client? Because you said there was a variable in there. I just want to make sure we cover it.
Correct.
He might have to pay more 50 grand sometimes in that time period. What am I looking? What's really what could I have to maybe come up with then? What would your thinking be?
Well, I mean, I can run different scenarios, and I'm happy to do that. But if interest rates go from, let's say, 2.75% to 7%, then it might be, at some point, it might go up to $60,000. Remember, it's always for 10 years. So it's always going to be for a limited time period. And if interest rates go up, that also means that the carriers are probably going to be earning more on their portfolios. And as they earn more in their portfolios, their option budgets go up, which generally means caps go up and participation rates go up. So that usually means a good thing for the policy down the road.
This is an excellent case study. It really maps out what we're really trying to do for the client, and why Index Universal Life, especially with, I love high caps, unlimited caps, I love arbitrage, and now you're telling me, oh, I'm adding another thing with this carrier, I have COLA on top of it. I love all that. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.